Live from New York City, good morning to you. Busy morning so far. Equity futures just about positive by 1/3 of 1% on the S&P. The story so far this morning, the wrong kind of downside surprise on retail sales, the right kind of downside surprise on PPI, and then IP, industrial production, comes in a little bit softer too. Equities, with that, up higher this morning on the S&P and on the Nasdaq. On the Nasdaq by 0.6 of 1%. Elsewhere in the bond market, switch to the board, get to the bond market. We look a little something like this. Your 10-year yield lower by 16 basis points. Your 10-year 338.98 on a 10-year right now. A break of 340. A big rally in the bond market. This whole yield curve just sinking lower. Dollar weaker. Euro dollar 108.80. Euro dollar positive 8 or 9/10 of 1%. And crude up by a little more than 2%. $81.97. Let's call it 82. That rally continues on crude. About 25 seconds into the session, a broader equity market looks like this. On the S&P, up 1/3 of 1%. On the Nasdaq, up 0.7 of 1%. One stock to watch at the open, United Airlines. Recession, what recession? It's a beat and a raise of guidance as well. The CEO, Scott Kirby, saying this: we managed through one of the worst weather events in my career. We're now poised to accelerate in 23. Kaylee has more. Hey, Kaylee.
Hey, John. Well, the stock's certainly accelerating this morning. It's up about 3, nearly 4% at the opening bell, and taking its airline peers along for the ride as well. You have Delta and American each higher by more than 2%, and even Southwest, which is the one that really struggled with that winter weather, Scott Kirby mentioned, is higher by about 1.4%. This print for United came in way better than expected, not just in terms of the fourth quarter, but the guidance handily topped estimates. For the fiscal first quarter, the company is expecting earnings of between 50 cents and $1 a share. That is more than double the analyst estimate of 22 cents a share at the low end, more than quadruple it at the high end, and the full year earnings guidance of between $10 and $12 a share also blew past expectations. So really, really strong guidance, and it really all comes down to pricing power because of the remaining mismatch between supply and capacity and demand. That is why United and other airlines have been charging all of us high fares. That's a bummer for us, but it helps them when it comes to the bottom line. Just for United, the average fare per mile climbed 20.8% from 2019 levels in the quarter just reported. So that yield strength is really what is driving things. And in turn, it has helped drive the stock higher. United this morning is trading at its highest level in roughly a year and a half since mid-2021. But just keep in mind, we still remain well below the levels at which the stock was trading pre-pandemic. It was north of $80 a share back at the end of 2019. This morning, it's trading around $52.
Trying to recover now. Kaylee, thank you. Year to date, though, what a move. Up 38% year to date on that single name. And I say year to date, what are we, 10, 11, 12 trading days into the year so far? Another company on a victory lap is Moderna, the drug maker's RSV vaccine, proving highly effective in its final stage trial. The CEO saying the following: what we have is a very good vaccine with very strong efficacy to mild disease. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, traders are definitely cheering those trial results as well. You have Moderna shares up about 7% from the bell. And of course, this sets up a three-way competition for an RSV vaccine with other drug makers such as GSK and Pfizer. Pre-market, not as much action from them as for Moderna. But remember, both of those companies applied for U.S. clearance for their own vaccines last year. So let's dig into those results. We're looking at vaccine efficacy for less severe RSV cases. You can see that Moderna shot blocked about 84% of cases in that phase 3 trial. That's slightly ahead of GSK and well ahead of Pfizer. And JP Morgan came out and said that overall this Moderna vaccine, it compares well to Pfizer and is competitive with GSK. And of course, this is crucial to Moderna's bottom line. Obviously, we know that COVID was a huge boom for this drug maker. Sales went from $60 million in 2019 to an estimated $19 billion in 2022. But you can see expected to drop off to about $8 billion this year, John. So that pipeline is key.
Katie, thank you. The latest on Moderna, the stock up by more than 7%. Let's turn to tech. The layoffs continue. Microsoft planning to cut 10,000 jobs through 3Q, and Amazon starting to cut 18,000. Microsoft CEO Satya Nadella speaking this morning, saying during the pandemic there was rapid acceleration. I think we're going to go through a phase today where there is some amount of normalization in demand. We will have to do more with less. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, John. Microsoft up 0.3 of 1%, pairing some of its early gains in the session. 10,000 job cuts for Microsoft would amount to around 5% of the workforce. That's probably more than we were envisaging. Remember, Bloomberg only reported 24 hours ago that these cuts would focus in engineering. In terms of how this impacts Microsoft, a negative impact to EPS of 12 cents in the fiscal second quarter, which they should report at the end of this month. Another another way of putting it. It's a $1.2 billion charge. Layoffs are never pleasant, but investors seem to be cheering this news at least, although it's sort of trading in line with market. Amazon, much more significant gains, up 1.8%. We knew these layoffs from Amazon were coming. They're already announced. 18,000 jobs, which is 1% of Amazon's overall workforce, including contractors, but a higher proportion of corporate workers, around 6%. So far, those layoffs at Amazon have focused on the devices business. Our understanding is that when they start the process of cutting those jobs on from Wednesday onwards, that it actually will expand to the retail and other marketing divisions of the company as well. In terms of what that means for this earnings season, right, I think that these are the EPS expectations or consensus for the last 3 months of 2022. There may be some change in that, of course, given the actions that some of these companies have taken. But you and I talked 24 hours ago. We're probably coming out of an earnings trough when we get reports for the final 3 months of 2022. Beyond that, I think we're asking ourselves what the sort of longer term and health of this industry is. If not an economic recession globally, what does an earnings recession look like? And without these actions, can you cut your way out of an economic downturn? That really is the question for Silicon Valley and global tech right now.
The news this morning is Microsoft. I want to just sit on Amazon a little bit longer. Yeah. This is a company in 2019, as you know, had just short of 800,000 employees. A couple of years later, it had 1.6 million. It's come down since then, but I just wonder, Ed, does 18,000 get it done for that company, given the challenges that they're going to face?
Yeah, you look at the commentary from Andy Jassy. He's talked about how Amazon has survived economic downturns in the past, and they'll do so again. 18,000 jobs is the biggest cuts that Amazon's ever taken. The other way I'd look at it is that this is Andy Jassy kind of unwinding some of the pandemic era investments that Jeff Bezos made, right? They invested billions of dollars to increase their fulfillment capacity, hired many workers just to handle that pandemic era demand. That's not there anymore. The movement of packages and goods, particularly in North America, is just not at that same level. So it's an unwinding of a base that's no longer required.
Ed, thank you, mate. Looking forward to the coverage of the earnings over the next couple of weeks, starting with Netflix this week, then on to Microsoft next week, then early February we'll hear from Apple and all the rest. Just getting some comments from the St. Louis Fed President Jim Bullard, non-voter this year on the FOMC, but a lot of people still follow his thoughts. He's speaking at an event held by the Wall Street Journal. He says his 23 rate projection in December was for 525 to 550. Went on to say policy is almost restrictive. You've heard that phrase a few times in the last month or so. Are we at sufficiently restrictive rates? It's not quite there yet, is the takeaway from Jim Bullard. We need rates above 5% to continue to push inflation down. He wants Fed policy to err on the tighter side as insurance. So the decision, and I guess the challenge we're all facing this year in this market, are we trying to price in a growth slowdown off the back of monetary policy tightening and a Fed that's trying to get sufficiently restrictive, or are we trying to price in a global growth recovery off the back of China reopening? This is what PIMCO's Erin Brown's got to say on the matter. China's reopening should drive out performance this year in China. This will also help European equities. US stocks with international exposure should outperform more domestically oriented stocks, particularly as the US enters a recession. This favors US large caps over small. Erin, I'm pleased to say, joins us right now. Erin, fantastic to catch up with you. Let's talk about the gains we've already had. Big gains in Europe, big gains in EM, big gains in parts of the Chinese equity market. Why do you think these tailwinds are strong enough to overcome some of the headwinds out there?
So overall, I still am fairly pessimistic on the overall outlook for equities, but I think that there's going to be pockets of growth that should outperform. And I think you're going to see more differentiation this year versus what we saw in 2022. And so specifically, I think that those names that are really geared towards Asia and the China reopening story are going to be the places that are going to outperform and where you really want to hone in on your bets. And so there are names in the U.S. that I think should do well. Some of the luxury names, specifically geared names to international travel, and some of the hotel and leisure names should outperform. And then I even think some of the tech sector should also start to do well, particularly given the fact that duration we're now starting to see, or rates are starting to move lower. That should help to support, those long duration bets in the technology sector. And I think that you'll start to see those names do better. So anything that's really geared outside of the U.S., which must have more of its sales and revenue streams from international exposure, I think are going to outperform the U.S. as it heads into the recession.
So 3 buckets there: airlines, potentially; luxury, potentially; And then you've got US Tech on the third point. I want to get to US Tech in just a moment. Can we talk about the airlines first? Airlines year to date, United up 37%, American Airlines up 37%, JetBlue even up 31%. I'm not sure about their international exposure. So Erin, that raises the question, is this a flash in the pan, a bear market rally? What is this on the screen?
Yeah, so when I talk about travel, it's not just airlines. It's some of the more hotel and leisure companies as well. And I really look to those with more international exposure than the U.S. airlines, which I think are experiencing a little bit of a bounce just given the strong demand and sort of, that we saw, throughout the end of last year, as well as how well they've operated, despite challenges in the second half of last year. But I think when you really want to focus on is more the service-oriented and leisure-oriented travel names and hotel names outside of just airlines.
So luxury players as well. The luxury players absolutely flying. You mentioned that LVMH up 18% year to date. Hermes up by 16% year to date. Kering up by about the same amount. Kering up by 15% as well. Year to date, I keep saying year to date. Can we just remember it's January 18th? So year to date is just a couple of weeks. Erin, the one thing I wanted to discuss with you as well is tech. So Microsoft's just come out and made its job cuts. Could be in and around 5% of the company. Guggenheim downgraded the stock yesterday, and I want to talk to you about this quote from them. They said, while most investors see this name as a large, stable business that can weather any storm, it does have vulnerabilities, some of which could be exacerbated by the macro slowdown. We are in a prolonged macro slowdown, and no one is immune. Erin, can you just walk me through your expectations for this recession in the United States and how it stacks up with maybe part of the equity market, part of the tech sector that is more cyclically challenged than some people might appreciate?
So I think that's right, but I think that played out through most of 2022, and you saw material underperformance of the tech names on the back of, first, a slowdown in overall demand, and secondarily, higher interest rates. And now we're starting to see that a very, much more severe slowdown is priced in the tech sector versus what we're seeing across other cyclical sectors. And in addition to that, we're now seeing duration or treasuries, stop increasing in terms of rate level, and we're starting to see them actually rally and yields go back down lower. And so I think just given the fact that a pretty severe outlook for revenue growth is already priced into many of these names, and the fact that we're starting to see duration start to move in favor of treasuries, or move in favor of the tech sector, I actually think that the tech sector is one of the few sectors that is really discounting a recession in its outlook.
So yields have been coming down recently. They're down again this morning. I've got the 10-year down 16 basis points. I just wonder, I've asked this question a few times this week, Erin. I'd love your view on it. For the same reasons we're bullish on the global economy, relatively speaking, off the back of this China reopening, aren't they also reasons to challenge this view that yields should go lower?
Well, I don't think that we should be necessarily bullish on the U.S. outlook for the economy for 2023. I do think that the U.S. is heading into a mild recession or moderate recession throughout the course of this year, and we see it in the numbers this morning.
Yeah.
That should give pause to the Fed interest rate hiking cycle after, the next couple of meetings. And so I do think that, we'll likely see 50 basis points more of rate hikes, and that should be the end, absent, a significant spike in inflation. I think that the market's largely discounted that the rate hiking cycle, and as we start to see inflation move lower, as we saw again this morning with the PPI print, I do think that you'll likely see rates move lower, and the expectation that the Fed is done. And that, I think, is what's sort of underpinning some of the optimism, at least that I have, for the tech sector and for any interest rate sensitive sectors.
Sure, just to be super specific though on what I meant by what this could mean for the bond market, we're pricing in a global recovery off the back of this China reopening. That's reflected in what we're seeing in the luxury names, reflected in EM, reflected in European equities. And I'm trying to wonder how much of a factor that will be in the US bond market. So in the Treasury market this morning, we're responding to softer data, Treasuries up, yields lower. But if we're also pricing in a better recovery abroad, driven by China, what do you think that ultimately means for the trajectory of bond yields?
So I actually don't think it means that much. I don't think that you're going to see large economic spillover effects from China to the rest of the world. You'll see it in certain equity sectors, but it's going to be very specific. And what I think is different this time around than what we've seen in past, significant sort of rebounds in China is that historically the rebounds in China have largely been driven by big industrial production gains, which were felt from a ripple effect perspective, across emerging markets, across commodity sectors, across, more cyclically oriented sectors. This time around, I think the reopening is going to be very specifically limited to China domestically and to China demand for more service-oriented goods. And so as opposed to when you've seen it in the past, which were more industrial-led, this time around it's going to be more consumer-led, and it's going to be really geared towards travel, towards leisure, towards some luxury goods spending, towards getting back out in the world. And so I think that differentiation is going to have a materially different impact in terms of what, sort of the ramifications to the rest of the world. And you're probably not going to see the same growth impulse stimulus that we've seen in the past in the U.S., in Europe, in, the rest of the world.
Interesting. Erin, great point to leave it on. Just fantastic as always. Erin Brown there of PIMCO on the latest. Here's the latest on Microsoft. 10,000 jobs to go. The stock is just about unchanged on the session. Dan Ives of Wedbush, bullish on the name, said this is a rip the band-aid off moment to preserve margins and cut costs in a softer macro, a strategy the street will continue to applaud as management teams navigate this Category 5 near-term economic storm. Category 5 near-term economic storm, and 10,000 jobs to go at Microsoft. More on that through the day on Bloomberg TV and on Bloomberg Radio. Coming up, the US and China pledging to talk more.
These meetings are critical. I mean, these are the two largest economies in the world. It's important for the rest of the world that they work closely together.
We'll catch up with AMH down in DC next.
5% of the software giant's workforce. Microsoft will take a $1.2 billion charge in the second quarter related to that move. Retail sales in the U.S. dropped by the most in a year at the end of the holiday shopping season. The value of overall retail purchases in December decreased 1.1%, more than forecast. Retailers try to attract consumers facing the worst inflation in a generation. And Taylor Swift's album Midnights helped the singer generate $230 million in sales for Universal Music Group last year. That's according to JP Morgan Chase. Swift accounted for 3% of Universal Music's revenues from recorded music. The biggest boost came in the fourth quarter after the release of Midnights. And that is your latest Business Flash. Alex.
All right, thank you so much, Ritika. So coming up, opportunities in private equity. Henry McVeigh, CIO of KKR's balance sheet, will be weighing in as you had Bain Capital saying they see private equity is definitely not peaked. They still see solid returns, 18 to 20% as we've been expecting. A quick check in here though on the markets. S&P is just up by 0.4%. The Dow now flipping negative. We did have worse than expected industrial production numbers that coming in, inventories coming in bang in line with estimates, but the data just weighing a little bit. You're still seeing though a solid bid into the bond market. We're going to get more on how you invest in this time. Maybe it's actually time to risk on a little bit. The de-risking was the theme from last year. You're looking at a live, beautiful shot from Davos. This is Bloomberg.
Experts, great questions.
We're about an hour more into the U.S. trading session. You're looking at still a rally on the NASDAQ 100, up by 0.8%, but around off the highs of the session. Bloomberg's Kelly Lyons is tracking those moves. Hey, Kelly.
Yep, a rally for the NASDAQ 100, but really a rally for stocks broadly because the S&P 500 also is up about 0.4%. But I would argue the real action today is actually in other asset classes, specifically the bond market across the curve. Really remarkable moves lower. The 2-year yield right now down 11 basis points to 4.09, and the 10-year yield is at its lowest since September, down 17 basis points at 3.37. Of course, this is after a trio of economic data points dropped. You had disappointing downside surprises on industrial production and retail sales, perhaps the bad kind of downside surprise, but a good kind of upside surprise, or downside surprise rather, on PPI. All of that may be adding up to a Fed that may have to shift its focus more to the health of the economy and hike less. That could be contributing as well to the weaker dollar. We are seeing the Bloomberg Dollar Index down about 0.4%. What is interesting is as the dollar has weakened, we have also seen a remarkable reversal in dollar yen. Remember, the BOJ overnight defied traders' expectations and did absolutely nothing to change its policy. So at one point in the session, the yen was weaker against the dollar by about 2.7%. We have entirely reversed that move. Dollar yen now essentially flat on the day at 128.21. But of course, that may be traders betting that even though the BOJ didn't move today, it's still going to have to shift yield curve control going forward. Then, Alex, you were mentioning the outperformance of the NASDAQ 100. It is actually on an 8-day winning streak right now, as is the S&P 500 Information Technology Index, up 8.8% over the last 8 days. This is the best winning streak for this sector, going all the way back to September of 2020. A really remarkable run for some of these stocks that, of course, are sensitive to the yield story, so perhaps being helped out by the fact that yields are moving lower. And of course, this is just one area of growth that we have seen outperforming. Over the last week, there has been a significant margin of outperformance for growth relative to value. What is interesting is while that may be true on a kind of sector level, it's not true necessarily on a regional level, because Europe, which of course is seen as more value, still outperforming the U.S. up about 2.5%. And yes, Alex, that one was for Guy.
Fair enough. Fair enough. He appreciates that, no less. Kelly, thanks a lot. Really appreciate it. Bloomberg's Kelly Lyons. Some breaking news for you guys. Bank of America is freezing most hiring with plans to still fill some vital roles, obviously in stark contrast to the likes of Goldman Sachs as having its biggest round, one of its biggest rounds of layoffs ever. But Guy, Bank of America freezing most hiring with those plans. I'm just taking a look at what's happening with the stock right now. The stock is just about down by over 1%, so no real reaction yet on the news, Guy.
Yep. I would argue that freezing is better than cutting. You could argue, therefore, maybe a more positive picture, actually, at Bank of America. The other piece of news that we've been getting over the last couple of minutes is the Fed is announcing that Jay Powell, the chair, has tested positive for COVID. He has mild symptoms. I'm assuming that he is working from home. Alex, we wish him well.
We do. We wish him well and a speedy recovery. All right, well, Bloomberg caught up with Bain Capital Senior Advisor Stephen Pagliuca at the World Economic Forum in Davos. And we asked him what's ahead for the private equity industry. He had an interesting answer.
If you look at private equity returns, most firms are shooting for 18-20% rate of returns. And when one of your compadres asked me this question in 1993, saying, I answered this question in 93, 2003, 2013, and now 2023, basically they say, there's too much money in 93, too much money. The industry has gone 10 times over money chasing too few deals. You can't maintain those returns. Well, we've maintained those returns now for every decade for 40 years. Why is that? It's because the private equity model works.
Okay, obviously he's talking his book, but nonetheless, is the optimism warranted? Joining us now for his take, Henry McVey, CIO of KKR's balance sheet. Henry, good to see you.
Thanks for having me.
So, I mean, it's a fair point. There's a lot of criticism that says, hey, well, we've never been through a cycle like this with private equity as big. You're not going to make the returns. What's your take?
Well, a couple points I make. One is when you look at dry powder and private equity, actually uninvested capital as a percentage of either market cap or GDP, it's exactly what he just said. It's been the same level for 20 years. So there's a lot of talk, there's too much money, but you also got to remember the economy's growing and the market cap's growing. So we're still pretty optimistic about the business. I think, in my personal view, I think 2023 is going to be a great vintage for private equity. A lot of times when banks are pulling back, that's exactly when companies need capital. And I think we would say that the operational improvements that you can provide to these companies if you're in the right sectors with the right management teams, it's pretty dramatic. And so having spent my career starting on the public side, moving to the private side, I'm a convert, yeah.
Okay, so if last year was about, say, de-risking and worried about a recession, what's this year?
Yeah, so last year we talked about walk, don't run. We thought there were some storm clouds on the horizon. I'd say at KKR, we've got a more constructive bent. This is not a, jump into the, the deep end of the pool with everything, but certainly this is a great time to be a lender, and there are a lot of public equities that are on sale. And I also think you'll see us be active where a lot of companies want to reposition their footprints. We have a long history of doing corporate carve-outs, so I would look for that to be a big theme for us.
Henry, good morning. It's Guy in London. Let's tease some of this apart a little bit. If I take a look at the public market, and I take a look at the price action, I'm going to exclude the macro data for now. It feels like we are early cycle. That seems to be the price signal that we're getting from public markets right now. A, do you agree with that? And if so, is it going to continue for the rest of this year?
Yeah, so a couple points I'd make, which is, look, there was a lot of bearish, themes out there where people were, essentially saying the world's going to end. And let's take a step back. What's happened? One is China is coming on more strongly than people thought as they changed their COVID policy. Second is, whatever you thought about Europe, they've got more natural gas supplies than we could have predicted, and we've had a warmer winter. And then last week, nobody's talking about this in the U.S., but jobless claims were near a record low, 205,000. So the Fed is working aggressively. I was listening to the commentary beforehand. I mean, think about it. If you're the Fed right now, you've raised rates at a record clip, and actually financial conditions right now are easing, right? The 10-year is now at 340, and the dollar's weakening. So, our base view is they do need to do more, but they've blunted the goods economy, right? Guy, if you look at it, inflation for the goods is now down within their target of 2%. So where are we going to spend time? We should probably spend time talking about the services economy. That's where you have much more momentum and you've got much more inflation. But it's not as, we're not wildly bullish, but our thesis is keep it simple, do the things that are obvious in this market, and there's some things to do. And we've been excited about, we've gotten off to a good start this year, and I think, we invest on 5 and 7 year horizons, and you want to be in the market when things are down, and things are down.
The basis for everything is the cost of capital, which has risen quite significantly. And I'm wondering what kind of visibility you now have on what you expect that cost of capital to be going forward. And it does ultimately come back to this idea surrounding kind of where inflation's going. As you say, goods inflation coming down. We saw that in the PPI data, but services maybe not. I was listening as well to the head of the Norwegian Sovereign Wealth Fund a little earlier, the biggest sovereign wealth fund in the world. He's worried. He says it's a non-negligible risk that we see inflation re-accelerating in the latter part of this year. How confident can we be in that cost of capital right now? How confident are you in your visibility surrounding that?
Okay, so let me give you the positives and the negatives. The positives is last year, as we were in the fog of war, and what we were seeing across KKR and the balance sheet was there was lots of different cost of capital data points coming in where things didn't always make sense. You might see, private equity deal at 18, but the preferred was at 16, and of course you'd want to own the preferred or CLO liability. So there's a lot of mismatch. That fog of war is lifting, and the more that the banks actually get this risk off their books and they get back in the game, they'll help that. And so I feel good about that, and I think there's some real pockets of value, as I mentioned, particularly in credit and some of the things we're seeing in the public equities. So expect more there. On the negative, Guy, I think you raise a great point, which is China is re-accelerating potentially in 2023 at a time when inventories for commodities are really low. And most investors have actually gotten out of the commodity indexes. Very few of the big buy-side allocators own as much energy as they used to. They don't do as much in materials. So they've shrank as a percentage of the market caps. And so it doesn't take much to ignite the flame. And so those areas are going to act more early cycle. Our base view is this is a different regime. We've been doing a lot more with our balance sheet and with our LPs around real assets, particularly in infrastructure, real estate credit. And why is that? There's a higher resting heart rate for inflation. And so what I'm focused on is really 3 things. One is labor is going to be a more sticky input into the equation. 2 is the energy transition, and not enough folks are talking about that. That's actually inflationary, not deflationary. It's the biggest CapEx capex spend we've seen in decades. The internet, when it came along, was disruptive, but it was deflationary. The energy transition is actually inflationary. A lot of these commodities are produced in hard-to-find areas, and a lot of them are processed in China. And then the third thing, which you guys have been reporting on, is, look, there's a lot of geopolitical tension, and so supply chains are being rerouted, and we've moved from kind of just in case to just in time. And so, General Petraeus, who works at KKR, he talks about this move from benign globalization to one of great power competition. What does that mean for markets? It means that you're going to have more resiliency of your supply chains, water, data, transportation, and all that's a little bit awkward, and it's not as efficient. So our base view, I think that's a realistic thesis, that the Fed has a hard time hitting its 2%, and that we kind of bounce around a lot more. I don't think it's the 1970s, but the great moderation that we had for the past decades, where central banks could give you a ton of visibility, that's gone.
Well, because you're talking about a more structural inflation, longer-term thesis, rather than just, say, wage and service inflation at the end of the day. We did see a chart earlier about liquidity in the market and how much it's dried up.
Yep.
Is that opening up a bit, and what does that mean for you in terms of pricing?
So I love that chart, and we track that because it tells you whether people are oversupplying or undersupplying the market, and right now they're undersupplying the market, and so you want to be an investor or provider of liquidity when that's happening. The good news, I would say, is that we need a functioning global capital markets, and I think we're starting to see that. So as the banks clear more of their books, that'll take place. You're seeing some deals where we're using the banks, but we're also using private debt as well, and so they're different alternatives. So I don't think we're going to be back to the speculative days where companies with no free cash flow are going to get crazy valuations. But for basic private equity, where you make the company better, use some leverage, you get good management teams, there's an opportunity opening up right now. And frankly, I think that companies are starting to realize that they need that capital. That's what that chart shows. And so if you can get the proper marriage there, that leads to good outcomes.
Final quick question from me, Henry. We've just seen the Bank of Japan disappointing many, not delivering the shift higher in terms of the band for yield curve control. We've got a big move on the yen on the back of that. How difficult do you think the currency story is going to be this year? How much attention did you pay to that BOJ decision?
So I'm locked in on currencies. I think this is a huge deal. Even last year, people were talking about the bond market. I mean, what most prognosticators are talking about, stocks and bonds being down. They didn't talk about the volatility in the currency market. It's historic. And what we're saying right now at KKR is the dollar's actually peaked. And so it's an amazing, when you think about last night with the BOJ, the yen got hit very hard, and then ultimately it rallied back. And there are two parts to this story, Guy. One is the U.S. is starting to slow down, and I think the Fed's not going to get to 6% on short rates. And then second is, I do think the yen's going to continue to rally, because ultimately we're leaving deflation in Japan, and they're not going to normalize the way the Fed or the ECB did, but you got a new central bank governor coming in March, and this is probably time to take stock that things are a little bit different. And so that currency reversal, that's a great signpost about our thesis.
Henry, we could go for hours, but we have to let you go. We have to go back to Davos now, but we really appreciate you coming in. Thank you so much. Henry McVey joining us from KKR. And speaking of, we have more interviews for you from Davos. We're going to be hearing from Kenya's central bank governor. That's coming up next. This is Bloomberg. we're going to go back to Davos. Bloomberg Daybreak Middle East anchor Manus Cranney is with Kenya Central Bank Governor. Manus?
Alex, thank you very much. We're on the rooftops here in Davos. We are with the Central Bank Governor for Kenya. It is Patrick Njoroge. Good to have you, Governor, on the set. Look, the debate is this. It's about growth around the world. And what I need to know from you, and our audience want to know from you, is what growth have you penciled in for this year?
Thank you, Manus. This year, 2023, we expect growth to bounce up to 6.2%. Last year, that is 2022, our growth was 5.6%, and that was a complicated year, which followed growth in 2021 at 7.5%. And in the peak of the pandemic, which was the year before, it was just a contraction of 0.3. So you can see the trend, and we are getting a respectable growth this year.
What is going to help you? What is the tailwind? It seems as if we went into this vortex of despair in December, in the back of the fourth quarter globally. We seem to have come out of that vortex of despair. Do you share that green shoots of optimism that we'll avoid a global recession, which has an impact for you?
Sure. Thank you. Actually, we see Kenya as being very resilient. The numbers I just mentioned to you show the bottom line of resilience of the Kenyan economy. It is true, the global economy has been sagging, and the current, our sense, and talking to people in Davos, etc., is that the economy, the global economy, will rebound in the second half of this year. Now, you should also appreciate that we are not dragged too much, even though we are very open. We don't follow the, the large economies as much. Why? Because we are very local or very regional in terms of our partners, trading partners, etc. So one of the reasons for our resilience is our highly diversified economy.
But the other, talk to me about the currency, because the currency in of itself has had a bit of a bruising, hasn't it? I mean, the Kenyan shilling down 9%. Reserves are under pressure, is what people say to me. Is that the end of that drop? How do you see the currency's future in a global currency world, in an open economy like yours?
So our currency is floating. We have a floating exchange rate regime. So really that follows the pressures in the foreign exchange market, supply, demand, and we generally intervene only to slow volatility, to minimize volatility. So we don't have a target level or direction. Now, during the last year, you know that the dollar had strengthened dramatically, pushing everybody down. And that was one of the things that we faced. Secondly, as I said, there were significant pressures, increased demand from, for instance, oil importers, because as you can imagine, their demands for dollars almost doubled, actually. So there were those pressures. But at the same time, you also had positive inflows. We have our exports grew by something like 14% last year, and even think of the remittances. Remittances are at a record level. They've grown by significantly, more than 25% in the last 2 years.
Do you think, just briefly before we move on, do you think, why not? You're not going central bank governor. You might have a view. Do you think peak dollar is here to stay, or has she dropped as far as she'll go?
I think
give me one line.
Yeah, I think there are many dynamics. There are many things that are coming in, and it is very difficult to read, for instance, what the bottom line will be in terms of the advanced economy's monetary policy stance. So I think that is where we are in terms of trying.
Are you at the behest? Are you just at the behest of the Fed?
They are also, well, the Fed is one. What they do matters a lot for us. But I think at the same time, there are domestic issues. And I mentioned some of the domestic issues that we look at. But we have adequate reserves, more than 4 months of import cover. And at the same time, we will be borrowing some more, which will ensure that we can, we can sustain whatever, let's say, repayments, etc., going forward.
I want to talk about the borrowing, because if I look at EM and frontier markets, locked out from debt markets, when you say, Manus, I'm going to borrow more, is it that in the form of a syndicated loan? Can you update me? There's a $900 billion syndicated loan being put together. Is that what you're referring to? Will that help you through, or is there another alternative?
No, I think we need to see this in context. First, a year ago, we had intended to go to the market to borrow 1.1 billion in US dollars. But as happened, we were shut out from the markets.
Yes.
Right? So that never came in. Secondly, and it's something that we had programmed in the fiscal expenditures, etc., etc. Now, going forward, as the markets open, we'll need to top up, let's say, our foreign exchange, or let's say our external borrowing. But I need to say that there's nothing at this moment that is concrete.
Do you think you'll get back to the debt markets this year? Have you confidence that you will get back to the debt markets this year?
That is a question that is now being discussed. And the reason for that is, as you know, it is the national government, meaning the national treasury, that does the borrowing.
I don't.
And so that is the answer to the question. And they are now looking at the various ways of financing a specific, their budget. So I think this is something that is being considered. However, it is clear that the borrowing, whatever it will be, even domestic for that matter, will need to be measured borrowing, meaning to ensure that we sustain our debt levels in sustainably, etc., and begin to bring down debt levels.
Governor, we didn't even get a chance to ask you during your 2 terms whether you were a tough boss, but you're a good interviewee. Wish you well. Thank you very much. That is the outgoing governor, or his last term, I should say, for the moment, here from Kenya with us this morning. This afternoon, Guy. I've lost all track of time. Patrick Njoroge. Guy.
Davos will definitely do that to you. Manus, great interview. Thank you very much indeed. Bloomberg's one and only Manus Cranny with Kenya's central bank governor. This is Bloomberg. European equities continue to climb. It's been a theme. It is ongoing. The Stock 600, 457. We're up by another 0.3%. Miners are leading today. The pound is also tracking higher, 123.88. The dollar is off. We saw inflation data rolling over in the UK. Core is sticky. Problem for the Bank of England. Italy down by 17 basis points. That's the theme across the bond market. Coming up in the European close, Mary Callahan-Erdos, JP Morgan Asset Management Wealth Management CEO, joining us from Davos. That's next. This is Bloomberg. Wednesday, the 18th of January, European equities continue to chug higher. Broadly, the Stock 600 is higher. Yes, the FTSE 100 is lower. You are seeing drinks being the drag there. Miners are having a very good day. Miners, the best performing sector in Europe today. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
As we count you down to the close, green on the screen for Europe. The 600's up by 0.3%. Miners are doing well. Technology's doing well. I'll explain technology in a moment. The dollar is down. The euro is up. The pound is up. 108.30. Christine Lagarde speaks tomorrow. I think she speaks 3 times in Davos. Isabel Schnabel is also going to be speaking as well tomorrow. Keep an eye on that. Plus we get ECB accounts. Lots to talk about. And then we come to the chip sector, the technology sector. ASM International, ASMI are very strongly today. 9.92%. A very strong outlook statement coming through. The supply chain story is easing. This is at a chip equipment maker, pointing potentially to a positive story for chips. But that's not what we're getting elsewhere, Alex. Broadly, it feels like Europe is risk on at the moment. It feels like it's early cycle. The message from the chip sector broadly, I would argue, is maybe not. Actually, we're beginning to roll over. But maybe ASMI is a standout. Maybe a positive story there.
Or maybe it's a U.S. versus Europe thing. It does feel like Europe is a little bit more early cycle than the U.S. Also, I should say January 18th, happy 80th birthday, Mom, if she's watching. Okay, in the U.S., you mentioned the outperformance of Europe. We're getting the S&P rolling over a bit. We did see a nice little rally after retail sales actually came in a lot weaker than expected. We couldn't hold on to that. In part, you got industrial production for December really rolling over the lowest level since February of 2021. But, you know, the Fed wants to see that slow down. So the market reaction a little confusing, like what signal we're really getting here. Microsoft cutting as much as 5% of its workforce, that stock down. Usually you see those stocks moving higher on workforce cutting news. And we're seeing a really strong bid, though, into the bond market. Really nowhere else except for the bond market. You got yields down by about 10 basis points, but it's all across the curve, the front and the back. And the dollar index rolling over after you got those weaker retail sales data. Now the dollar index down by about 0.3%. It had been stronger versus the yen. Even that has rolled over a little bit there, Guy.
Absolutely. I think it's really interesting what you say about potentially Europe feeling early cycle, the United States maybe still feeling late cycle. The weather's playing a factor here, plus also what is happening with the China story, and that certainly is driving a very strong narrative in terms of European outperformance. And our question of the day, therefore, is a fairly straightforward one that is being kind of produced session after session. Sell the United States, buy the rest of the world. That seems to be the trade right now, Alex. How long it continues, I don't know. But you've got two really strong factors which I think have caught a lot of people on the hop. China and the weather.
Yeah, but you mentioned ASMI, and I get that point, but then you get Citi saying that they see the U.S. semiconductor estimates are going to come down further because they're driven by weakness in personal computer, wireless, and consumer end markets. And I appreciate that might be a U.S. semi story, but that's where I feel like I wonder how much we're diverging. Let's stay on tech for a second, Guy. So Chuck Robbins, Cisco CEO in Davos, talked about layoffs earlier today on programming.
Right now, we made a decision that we need to invest so heavily in cybersecurity that we made a decision to actually take an action in order to free up that capacity because we needed to do it faster. So it really is a pace at which you need to make that shift, and that's what drove the decision for us.
Let's get a little bit more context on what is happening with the story surrounding tech layoffs. We're getting tech layoffs. You've got Microsoft now in the mix as well. Ed, just kind of pull this all together for me in the signal. Sorry, Ed Ludlow joins us. I should probably introduce him. That would be the smart and, to be honest, polite thing to do. Good morning, Ed. Back in San Francisco. It feels like you're part of the team, so it just feels like I can just bring you in at any moment. Sure. Ed, let's talk about the narrative that we're getting right now. You've got the chip sector laying people off. You've got Microsoft laying people off. Yet the signal we're getting elsewhere in the economy is potentially early cycle, a re-acceleration. What macro signal should we take away from what we're getting from tech right now, and in particular the semis?
Yeah, I think there's kind of this unraveling of pandemic-era demand. You know, it's not quite semis, but, you know, Microsoft CEO Satya Nadella basically said that the technology industry is entering this period where there is a normalization demand, and so the industry needs to react to that and kind of be a bit leaner. You know, the similarity with Amazon is that they're kind of unwinding what was basically pandemic-era bloating, right? They invested heavily in fulfillment centers and staffing to handle what was a shock to the system in terms of demand, because for a long period of time we all worked from home and we did our shopping online, and you see the kind of headlines reflect that. And the street, you know, the layoffs are never pleasant to discuss, right? It's not a nice topic, but actually a lot of these stocks pushing higher in the session this Wednesday because the street kind of is cheering the fiscal prudence and then looking at this, and it extends to the chip sector as well as a way to protect margin when that demand is falling away.
Ed, we appreciate it, and also thank you for the hustle and good context for us there. Thank you very much. Ed Ludlow joining us from San Francisco. From San Fran to Davos, Wall Street Week anchor David Weston is now sitting down with Mary Callahan Erdoes, JP Morgan Asset and Wealth Management CEO. David.
Thank you so much, Alex. As you know, Wall Street Week has come here because all of Wall Street, particularly global Wall Street, is here, and that is led by Mary Erdoes. Thank you so much from J.P. Morgan. Great to have you here, Mary. Thank you for joining us.
So happy to be here. Although I felt like I was here all week watching you on TV in New York. Yesterday, you brought it all to life for us.
Thank you, Mary. Yeah. That's nice you say. So a lot of talk here about the economy, global economy, U.S. economy. Is it turning down? Is it not? Recession, not recession? I mean, something like people with $4.1 trillion have entrusted their hard-earned wealth to you to manage. How do you manage into a world where there may be a downturn, may even be a recession? How does it affect your decisions?
Yeah, it's a great question. First of all, I would say the tone here, having come here for the past decade, is less depressed than it often is, which is a good sign of hope of what's happening out there in the world. Having come off of the most difficult year for a balanced portfolio, 60-40, whether you were in stocks or bonds or anything in between, it was pretty rough sledding. And so I think everyone's happy that that's behind us and looking forward, and the job of what all of us at JP Morgan do is work on advising clients through the cycle. And so we're going to have lots of boom and bust cycles. You've had a few people on today talking about it. And I think the most important thing is to stay focused on diversification, opportunity, not getting wedded to any one thing that looks like it worked in the past. It may not work in the future. And so we're spending a lot of time on that. I mean, one of the things that really manifested itself through COVID was the problem of home country bias, which creeps into almost everybody's portfolios. And you have to be very aware and conscious of diversifying out of it. So not only home country bias in terms of the stocks and the bonds you buy, but also the currency. And I think it's now a really important time that people think about how to get all of that, the opportunities that they may have missed in other parts of the world, especially parts of the world that are, reopening and making it very interesting.
How about that, China? We have had the development today of Liu He, the vice premier, meeting with Janet Yellen, not too far from here in Zurich, to try to start talking again. What do you project for your investment purposes about what is likely to go on with China, and how hopeful are you that that reopening could really stimulate the world economy?
Yeah, absolutely. Having come back from Hong Kong just a few weeks ago, you can just see the pent-up demand of what's there, people wanting to go in-country, people wanting to come out of country to travel around the world. I think the opening up of China, while it will have its ups and downs, it will hopefully be a net exporter of deflation, which would be good for the world, getting all of those kinks out of the system and really bringing back growth in a positive way. So I'm looking forward to that. I just say for us at JP Morgan, getting to see our people who are on the ground in China and have been working so hard throughout these many years of us not being able to travel in. We're really excited about that. We're looking forward to lots of good reunions and the like, but people are really excited. And I think it means a lot of things. The tone that you're hearing from many that are either going in already and or are just listening to some of the conversations here today are really positive about what could be happening. And of course, there's all sorts of negotiations that have to happen to make sure that people do things in the right way, that people work forward to cooperation on a fair and even playing field. And I think that those are the important conversations that have to be had. But now that we can do them in person, it's going to be a hell of a lot more fruitful to be able to do it that way than to try and do these things on some kind of a flat screen where you're not able to have those personal connections that are so important when you're going through these negotiations.
You mentioned the possibility of China exporting deflation. That makes me think about supply chains, opening up some supply chains.
Yes.
More generally, do you think that there is some reassurance on the inflation front? 6 months ago, probably, we would have been talking about just inflation. It's still real. It's still out there, but it seems maybe to be coming down some. Do you anticipate freeing up the supply chains to actually be a counterweight to the inflation we've seen?
Yes. I mean, it's a funny thing when people say inflation has peaked, or it's not. Inflation is just going to grow slower. We still have, goods and services that are up 15% over the past 2 years cumulatively. And so if you only grow at 4% for the next 2 years, you're going to find yourself at things that are up 25% from where they were before we started this. So that's a lot to digest. And wages have to keep up with that. Savings have to keep up with that. We've had nice cushions, particularly in the U.S. consumer. We bank half the households in the United States of America through Chase, and we can see a lot of the actual data. There's been a nice cushion of days of cash on reserve in people's accounts, but that's depleting. And for the lower income, it looks like that might get back to pre-COVID levels of about 19 days worth of cash excess by the time summer comes. That's not a lot of cushion to be able to think about where that money needs to be spent. And when prices continue to increase, you need to have the system in balance. So, the Fed is doing its job. Effectively, the Fed funds rate is even higher than what it may appear to be. There's some studies that show that it may be as high as about 6.5% effective in the world. And so the whole world is priced off of fixed income. It's priced off of what is the discount rate you're going to use on future earnings. So that's the most important conversation that we're having. But thankfully, we're having it with yield back. And so, bonds have always been a very important part of the conversation, but with many of them negative yielding for the past several years, it's a much better time to think about bonds in the portfolio and a positive contributor. And so I think we're going to have a better sledding going forward.
Which takes us back to your portfolio. As you say, it's got to be balanced, and you referred to 60-40 before. When you have the discount rate really going up, it favors bonds. Does it disfavor equities? Is this a bad time, actually, to really be doubling down on equities because that discount rate is going to discount your future cash flow?
Yeah, I think most of that's fairly priced in. It's going to depend on where things go on any given day. It also depends on currencies and how you think about that. But most importantly, it depends on profitabilities of companies. So they have to go back to being profitable. You're seeing companies rein it in a little bit. Lots of announcements coming out over the past couple of days. And so on the margin, people are going to be really fine-tuning how that works. And those that continue to show profit and growth for that, they should be rewarded with high PE ratios. And those are the companies you want to invest in for the long term. And this is really about long-term investing. So that's the focus. That's what people have to keep their eye on. And that's what we spend a lot of time doing at JP Morgan.
In your letter this year, you described the growth that you've had at Asset and Wealth Management at JP Morgan, and it certainly struck me. It was substantial growth. You've added a lot of people entrusting their hard-earned money to you. How are you doing that?
No, it's hard work every day. I think the real benefit of JP Morgan Chase is we are on the ground around the world, and we are in touch with what's going on in a way that maybe others are more limited. And I always say it's irresponsible to be investing in today's world if you're just going to do it passively and you're going to sit back and you're going to think that the world's going to take care of it. It's equally irresponsible to think that you can only focus on one part of the world and not think that the whole place is interconnected. You have to understand what's happening in China. You have to understand what's happening in India. It affects the local company you're investing in whatever country that you're living in. And so all of these things are really important, and our insights that we bring to bear for our clients and the opportunities that we can present them with, whether it's in the public markets, in the private markets, lots of climate tech opportunities. Just there's an enormous amount of things that people are passionate about wanting to invest in, and I think that's an exciting time for us.
You mentioned climate tech. As you build your business one client at a time,
yes.
How important is environmental, social, and governance? I mean, is it something that they bring up to you? Do you retain clients that way? Do you lose clients because they're not so enthusiastic about it?
I will say that the letters ESG are not actually directly related with each other. There are three different and important letters, and all three of them are important with different degrees to different clients. And it's our job at JP Morgan to think about how we express a client's desire of where they want to invest, how they want to invest, what's important to them. And we express that through different vehicles in different parts of the world. And I think we do a really good job of that.
Mary, you've been coming to Davos for a while now. What's the biggest difference this year, do you think?
I am shocked that there is no conversation about COVID. I am equally shocked that there's very little conversation about crypto. And there's not even hand-wringing about things like cyber and the like. So I think the worry list is still out there. People have to keep it on the forefront of their minds, and the answer to every question is diversification.
Yeah, but all in all, pretty good messages, actually. Thank you so much to Mary Erdoes. She is president of JP Morgan Asset and Wealth Management. Back to you now, Guy.
David, great stuff. Thank you very much indeed. Fascinating conversation. David Wester, Wall Street Week anchor with Mary Callahan-Erdos, JP Morgan Asset Management, Wealth Management CEO. I want to talk to you about some of the stocks that are moving in Europe today. A really fascinating session underway. EQT, one of the world's largest listed private equity firms, under real pressure today. Over a two-day basis, down by nearly 7%. The company is basically coming out and saying the tougher environment on deal flow basically is making it harder to raise money. Now, this contradicts some of the messages we're getting from other areas of the private equity universe right now. We've been hearing a number of people talking about how they see this year as delivering a really positive vintage for all private equity. EQT maybe taking a different stance on that. Let's talk about some of the other stocks we've been mentioning. We were mentioning what was happening in the chip space just a moment ago. Odo out with a really positive note after the ASMI numbers earlier on. That stock up by nearly 10%. They're raising their price target to 330. That doesn't feel very far away right now. Easing supply chains, the story here. That comes back to that narrative, maybe surrounding China. In terms of what else we're watching, plenty of other stocks on the move here in Europe as well. I want to talk about Just Eat. We get Deliveroo tomorrow. That stock up really quite sharply as well on some really quite solid numbers as well. Remember, we get Deliveroo numbers tomorrow. Look forward to that. And then let's talk about some of the 52-week highs. We've got a number of the luxury stocks out with numbers this morning. Richemont, Burberry. The market seems to be looking through the problems they're having short term with China. Burberry up quite nicely, 52-week high there. The luxury stocks are doing well. Lufthansa potentially looking at ITA, the Italian airline, the successor to Alitalia. But Lufthansa up at a 52-week high. Safran up. Commerzbank tracking at a 52-week high. European stocks continuing, Alex, to perform very, very strongly.
Yep, the outperformance. U.S. equities now turning lower. S&P now down by 0.4%. All right, let's get it back to Davos now. Bloomberg's Lisa Abramowitz is standing by with Qualcomm's CEO. Lisa?
Thank you so much, Alex. Right now, yes, we are here with Cristiano Amon, Qualcomm Chief Executive Officer, at a time when everyone is focused on the semiconductor industry, how much we've seen in terms of the boom and then perhaps some of the softness and then perhaps what people are expecting down the line when everything becomes automated, we become replaced by computers. But I want to start with the smartphone industry. Where are we in terms of the downturn, both in smartphone sales as well as on the chip side?
Look, I think we saw an acceleration of people buying better phones, new phones, especially when phones became very useful for collaboration and how people were communicating during the pandemic. And we saw that acceleration. Now, when you have the macroeconomic factors coming from the supply chain constraints and what happened in China during the lockdown, we have saw that the smartphone market slowed down a bit. I think people were buying less phones based on those three factors. The good thing is, I think we expect to see two of those three factors to probably not be there anymore in the second half. I think China, there is an expectation that they are going to resume growth, and it's a big phone market as well. And, you know, their inventory correction due to the supply chain shortage, we predict it's going to take, 1 or 2 quarters. We're going to see that happening. So, and there's still a lot of excitement with 5G and some of the new services coming to the smartphone industry.
Just to focus a little bit on China, you mentioned them coming back online, and there's been a lot of discussion about that. How open do you feel like the Chinese leadership is to non-Chinese businesses being more dominant there and continuing to do business in a sort of free way?
We are very fortunate, I think, in our position, and I think we have a very successful relationship with China. We provide technology that it's important for the Chinese OEMs, especially to build devices, not only for their own local market, but the other markets in export, and at some time generates growth for them. If you're a leader in technology and you have something which is leading edge and differentiated, you always going to have a big market in China, just as GDP. But we have seen actually China being welcoming partnerships. And as our company is diversifying to other markets as well, automotive, industrial, we see our relationships in China also expand to those sectors as well.
You mentioned that, and you've been trying to expand outside of the smartphone more and more. What industry do you think will be the leader in 5 years, if it's not smartphones, with respect to chip sales?
It's a good question. The smartphone, if you look at the the phone market is the largest consumer electronic market right now. However, the smartphone technology is going to everything. Everything around us is becoming connected and intelligent. So I think there's a very large opportunity of what we call industrial IoT, the digital transformation of enterprises, especially as computing starts to move from the data center to what we call the edge. So that's a good opportunity. And of course, we have been a lot vested in the automotive industry. We're very excited about the technology transformation happening in the industry. It's electrification and it's digital, and we think that's going to be a great part of our business going forward.
How much do you deal directly with the auto manufacturers and not so much the intermediaries that traditionally have been the main bread and butter?
Actually, I love talking about this. It's a great question. One thing that we learned over the past 2 years when we have the shortage of semiconductors is that I think it was determined that semiconductors and chips are very important. And I think what happened is this process of transformation in the auto industry, the OEMs realized they need to have a direct relationship with the technology provider. Still, in many cases, we supply our technology to their suppliers at Tier 1, and Tier 1 will continue to have a very important role. But the OEM now cares and wants to be involved in the technology that goes into the car, because the car is becoming a connected computer on wheels, and those relationships are becoming stronger and stronger.
You mentioned the supply chain disruptions, which is part of the reason why you see this strengthening in different relationships, people reaching out to you from all walks. How far have we gone in actually solving some of these issues? Because we did see this rampant shortage, a rampant ramp up in production, and now huge inventories, a glut, sales, and downward projections for earnings.
Yes. So taking the first question, I think most of the supply chain shortage is behind us. I know that's not true for all the semiconductor companies, but for us, we don't have shortage now in any of our products. And that came as a result of investments that were put by our suppliers, by ourselves, over the past 2 years. So that's kind of good news. And I think there are going to continue to be investment in semis, regardless of the macro in the current short term, because we know that we're going to have to double the global throughput of semiconductors just within the next decade. The second part of the question is this whole inventory situation. What happened is every time you have a shortage, and the semiconductor industry has those cycles. We've seen some of those cycles before. Once you have a shortage, companies build inventory. Then when you get hit with the downturn, companies reduce inventory. And I think that's a cycle of the industry. We've seen that in all markets. We saw that on the phone. We saw it on PCs. We saw it in automotive. And I think that's just going to normalize after a few quarters.
Well, that's what I was going to say. So you think it's just going to take a couple quarters before we're back to some sort of normalcy. What does that normalcy look like? Because we're not heading back to the pandemic levels, are we?
Yeah, that's. I think that's the question we all try to determine. We're going to remove some of those, if I call it artificial, impact on the demand, which is the inventory and the China lockdown, and then you're left with the macroeconomics. But as we started to see signs of inflation, receding a bit, and I think companies continue to invest in technology, especially because you invest in technology for growth, you invest for cost reduction. I think I'm more optimistic than many as we think about the end of the year.
How concerned are you about the likes of Apple, and Apple in particular, going internal for their chips and really focusing on developing their own product?
Yeah, we are a supplier of the modem that goes into the iPhones. I'm sure Apple will see us as a great supplier. I think, what we do for a living is communications and computing, and I think we always been in the forefront of cellular. We have said back in 2021 that we expect Apple to use us all the way to 22. We updated in the last earnings call that they decided to continue using Qualcomm in 23, and we're making no predictions for 24.
Okay. Just want to wrap up with one issue. We've been talking a lot about the political backdrop in China, and there's been a lot of questions about trying to localize production of chips to sort of insulate from some of the geopolitical risk. How is that affecting the way you do business or the way you look out at some of your strategy going forward?
You know, the reality about chips, and if I just pick something, for example, if you buy a smartphone with our chip with the Snapdragon processor, let's say you buy the latest Galaxy from Samsung. When we provide a chip there, we have a processor in 4 nanometer, but we have RF in 14 nanometer. We have, codecs in the 28 nanometer. We have power management that connects to the battery in 150 nanometer. So there's a wide array of technologies. Technologies that are 20 years old, 10 years old, and leading edge. I think China is not today in the leading edge, but they have been building semiconductors for legacy products, and I think that will continue. And at the end of the day, I think the China economy will continue to rely on advanced technologies. A company like Qualcomm play a role, and they actually could become suppliers of the semiconductor supply chain, especially for legacy technologies.
Cristiano Amon, thank you so much for being with us. Terrific speaking with you. That was Cristiano Amon, Qualcomm Chief Executive Officer. Back to you, Guy.
Lisa, thank you very much indeed. Fantastic interview. Really interesting to hear what was said there about the supply chain story, because if you take a look at what is happening with ASMI today here in Europe, the chip equipment maker, talking about an easing of the supply chain story. This is the picture, the broad picture here in Europe. FTSE 100 lagging a little bit. You've got names like Diageo and Unilever under a little bit of pressure. Names like GSK. Some of the miners are having a much more positive day. Kind of the two ends of the FTSE 100. The DAX is just beginning to roll over, as is the CAC 40. I think we're being led now by what is happening stateside. European stocks, potentially we'll see how we finish up here. May have a positive session, but I think it's going to be really, really close. The European close is coming up next. Details to follow. This is Bloomberg. So European equities kind of rolling over into the close a little bit here. Are we going to hang on to positive territory at the moment? We're up by around 0.2% on the stock 600. DAX has now gone flat, CAC's flat. FTSE's been down a little bit more. As I say, we've got names like Diageo, Unilever, some of the consumer-facing names, some of the drinks companies just rolling over a little bit, but the miners have had a good day there. Let me walk you through the session. You can see this kind of rollover that we're seeing. Feels like it's being driven out of the stateside, maybe being driven by some of the data that we've been seeing as well. So 457, we're up by just under 0.2% right now. We'll see what the auction brings in terms of the final numbers. But at the moment, it is another positive session for European equities. Let's walk you through the sector price action. As I say, the miners back, feeling like they're having a good day. Feels like that's the China trade again. Technology is up. That's ASMI. We've already talked about that. Industrial goods and services. Travel and leisure up as well. Lufthansa making another 52-week high today. In terms of some of the individual names, I want to move forward and talk about what's happening there. We are seeing some really interesting trades around Europe today. ASMI talking about supply chains easing in the chip industry. That's positive. Burberry. Yes, we're seeing some turbulence for Burberry and Richemont short term in what is happening in China, but the market seems to be looking through that today and saying, you know what, actually, if you go just beyond the kind of almost immediate near term, there's a positive story to tell here. So Burberry, 52-week high today, that stock up by 3.34%. EQT, the private equity business, though, down quite hard today, down by 6%. They're talking about deal flow being muted. They're talking about the IPO story being muted. They're talking, therefore, about raising money is being muted. The market didn't like that. So EQT down by over 6%, Alex. But broadly, it looks like we are hanging on to another positive session. Yeah. Let's talk about the day ahead, because I want to go there. Sorry.
Do it.
French strikes tomorrow. I'm sorry, I got ahead of myself. French strikes tomorrow. Keep an eye on that. You also got UK strikes continuing. You got ECB accounts tomorrow. And then what I think could be the main event tomorrow, Alex. I think Christine Lagarde speaks. I think it's twice. It could even be 3 times tomorrow at the World Economic Forum in Davos. She's not talking to any of the media directly, but I think she's going to be giving kind of 3 speeches effectively tomorrow. The world is going to be paying attention to what she has to say.
Particularly as we reported yesterday that the ECB is considering 25 basis points. That's not off the table. But then today it was very much something different. In an exclusive interview from Davos, Governing Council member and Bank of France Governor Francois Villeroy told Bloomberg TV that 50 basis points is still the thing.
Let me remind you of the words of President Lagarde at her last press conference in December. We should expect to raise rates at a pace of 50 basis points for a period of time. Well, these words are still valid today. But again, we are pragmatic.
Well, joining us now, Jane Foley, Rabobank Executive Director and Head of FX Strategy. I'm looking at 108 on euro dollar. Jane, it's good to talk to you. What are you looking for tomorrow from Christine Lagarde, and how do you trade it?
Well, clearly it does seem that she could still be hawkish, but there's a lot of course, uncertainty about that. But I think we need to be, realistic about what we're looking at in terms of the inflationary forces that we're facing, and not just in Europe, but everywhere this year. And I think we've got to really determine the difference between goods inflation and services inflation. And I think one thing is clear. We see it in the technology stories, and the fact that they're laying people off, that goods are down. In fact, you can see even in the UK inflation data today, goods inflation is pretty low. We understand that supply chains are repairing, etc. That's all good news in terms of the supply of goods. But if we look at services inflation, well, that's going to be a lot more sensitive to labour markets, and almost across the whole of the OECD almost there are shortages of labour, and this means that the prices of our services, going into a restaurant, asking for a haircut, etc., could be sticky. So this is something which I think is going to become clearer in the months ahead. Yes, inflation is going to come down. Yes, goods inflation is, but it's still going to be difficult for central banks to shave those last few percentage points off inflation. And that's something I think we might get a little bit more direction from, perhaps from Lagarde tomorrow, but certainly in the months ahead from all of these central bankers.
Jane, what do you think the story was yesterday, therefore? We had this Bloomberg story, Jana Randau and the rest of the team putting out a real market-moving story on the Bloomberg with this idea that you get 50 and then you downshift to 25. The message thus far from Lagarde has been, we're on track for a series of 50s. Was that a trial balloon? Was that a sort of a misread of the message? What do you think is happening here?
You know, I think it could be a testing of the water, perhaps, as you suggest. But the other thing to bear in mind is that, you know, foreign exchange probably does come into this, because if, for instance, the Fed does move down into 25 basis points increments, then, you know, maybe there's less pressure on the ECB to have to do these 50 basis points. We've had this recovery of euro-dollar now back to 108. You know, that surely means that the ECB is more comfortable, you know, that they're not going to be importing inflation in the same way as they were when the euro was softer. That is, you know, something that's pretty encouraging for them. So, yeah, you know, they will almost certainly move back to 25 basis points increments, and maybe they just want to see how vulnerable asset markets are, how vulnerable the euro is if they test the water with that. But hopefully we'll get some clarity tomorrow from Lagarde.
I mean, clarity feels like a long shot at this point. Where do you think the trade will mostly lie, though? Will it be with the euro or will it be with the dollar at that point?
You know, I think this is really interesting that you pull this apart, because I think, you know, all year we have two different stories here. We've got the euro story, which is one of the market becoming far less pessimistic about the outlook for the eurozone. You know, the fears of recession that we saw towards the end of last year, you know, into the autumn, you know, have really more or less been gone. And so that's one thing for the euro. It's much more optimism. We see that in European stocks, for instance. Now that partly feeds into the dollar story, because when there's optimism everywhere, there's less reason to run to the hills and buy the dollar. So you see reversal of that trade. But we also have this story about the US with the market thinking or disbelieving that the hawkishness of the Fed, expecting that interest rate cut before the end of the year, looking at the economic data such as the ones we've seen today and seeing that poorer data, and that's feeding the softer tone in the dollar. But I think tomorrow, bearing in mind that we have Lagarde speaking, I think it's going to be a day when we're focusing very much on that euro side of the story.
Jane, was today an opportunity to buy the yen, do you think?
Yeah, I think it was, you know, and this is, you know, economists, you know, this is, you know, 1-0 to economists, 0 to speculators today. Anyone who's been reading the speeches of the Bank of Japan policymakers over the last few months would have been very, very, very skeptical that they would have widened that yield curve control band even further. So the economists got it right, and the speculators got it wrong. But I think economists would have always said that, well, yeah, okay, so maybe they're not going to do something today, maybe they're not going to do something in March, but they certainly could do something in April and the spring. So yes, you know, from that point of view, when the yen was to weaken, you buy it back. You know, it's going to offer good levels, and that's perhaps what we have seen today. The market perhaps, you know, a little bit going away with its tail between the legs, and now perhaps more skeptical that Kuroda will do something in his last meeting in March. But by March, we should have a really good idea who that next Bank of Japan governor is. You know, the list of nominees is going to be presented to Parliament in February. So by the end of February, we may know who that's going to be, and that should give us a pretty good idea about, you know, whether there's going to be a move in policy in April or later in the spring or not.
And Jane, what we're definitely going to see, though, is the market continuing to push around the BOJ to see kind of how flexible where that band is, how aggressive they're going to be buying bonds. What's a nice trading range for you? Like when you look at the short-termism of dollar-yen, how do you trade it?
Well, you know, I think trading ranges for everything this year and last year are just going to be wider than they were before. And so from that point of view, you know, I would still be looking at, you know, 130. If we see moves back to 130, I think that's a nice opportunity to buy the yen, certainly. But of course, a large part of the movements will be fed by the dollar. And right now, you know, the dollar is pretty soft. But, you know, whether or not we'll have, you know, more reason for the market to believe the hawkishness of the Fed or not remains to be seen. I think the dollar is going to be choppy all year, and that's going to be exhibited really in many of these other dollar crosses.
Jane, always great to catch up. It's going to be an interesting day tomorrow, isn't it? Jane Foley of Rabobank joining us ahead of Christine Lagarde speaking in Davos tomorrow. Quick look at where European stocks have settled as we head in towards the break. These are the final numbers. As you can see, a little softening in the last few minutes. The FTSE 100 in negative territory, with the DAX just slipping down a touch. The CAC 40 basically finishing fairly flat on the session. We've had a series of very positive sessions for the Stock 600, which did just manage, by the looks of things, to finish in positive territory at 457, spot 53. Alex and I will be leaving TV very shortly, going over to Bloomberg Radio, the cable show at 5 p.m. London, 12 p.m. over in New York. We're on DAB digital radio. Podcast we found a little bit later on Spotify and iTunes. And we're going to be talking as well about the UK inflation data. A little bit of a softening, but as we heard from Jane, sticky core inflation still a problem.
Yes, same here too. All right, next up, guess what? We're going back to Davos. We're going to highlight our conversation with Blackstone CEO Steve Schwarzman. Always want to pay attention to what he says. We're going to go there next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. In Ukraine, the country's interior minister and at least 17 others were killed today in a helicopter crash. The helicopter went down near a kindergarten and an apartment building in a suburb of Kyiv. At least 29 people were injured. No word what caused the crash. The Interior Ministry has been investigating alleged Russian war crimes. Inflation in the UK dipped in December for the second month in a row. According to government figures, consumer prices rose 10.5% from a year ago. Still, inflation is 5 times higher than the Bank of England's target. The central bank has raised interest rates 9 times in a row since December 2021, and another rate hike is likely next month. Treasury Secretary Janet Yellen and her Chinese counterpart may meet later this year in Beijing and Washington. The Treasury Department hinted at the plans after Yellen and Vice Premier Liu He held a closed-door meeting today in Zurich. U.S. officials said the two exchanged views on macroeconomic and financial developments. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, Ritika, thanks very much. So U.S. consumers pulling back on shopping. I can tell you that I am sticking to my budget, by the way. Data out earlier showed that consumer spending fell by the most in a year. Blackstone CEO Steve Schwarzman, though, sees a resilient consumer. He sat down with David Weston, host of Bloomberg's Wall Street Week in Davos.
Well, I think in the United States, we're obviously fighting higher interest rates, but we're doing it from the perspective of an economy that's in quite good shape. One of the reasons for that is an outcome of the pandemic. And during the pandemic, people stayed at home. What every country's government didn't figure out is the 90% who kept being employed would end up having way more money after the pandemic because their cost structure collapsed. They didn't go to movies, they didn't leave their homes, they didn't travel, they didn't buy expensive clothes, and that $2.5 trillion of extra money was in the banking system, and they've been spending that money. And that's been keeping the economy performing better than people expected. They've spent about half of it. Whether they spend the rest of it, whether they save it, but that's an extra stimulus, if you will, that's kept the U.S. economy moving ahead pretty well. The Fed, of course, is trying to do something with inflation, and they have to, assuming they really want to get it all the way down to 2%. So they've been very aggressive, moving, and the question is, how much effect does that have? We're starting to see the economy slow down a little, and particularly in interest-sensitive areas. One would think it would have had more impact, but it hasn't yet. And the reason we've developed almost a two-part economy. Interest-sensitive areas like housing, where new house construction is down 19%. Usually in a recession it goes down 35%. So you can see how far we are away from the bottom. It's affected Wall Street and markets because when you raise interest rates very high from a percentage of where you started, it'll have adverse incomes. And there are other parts of the economy that frankly are still extremely strong, that raising interest rates hasn't affected yet. Stuff like travel. Airlines just can't even cope with the volumes. Resort hotels. People after the pandemic were so grateful that nothing worse happened to them, that they just want to celebrate and live life.
That was, of course, the Blackstone CEO, Stephen Schwarzman, speaking with Wall Street Week's David Weston a little bit earlier at the World Economic Forum in Davos. David's not done yet. He's going to be sitting down with Bank of America Chairman and CEO Brian Moynihan for another Wall Street Week interview. That's going to be taking place tomorrow. The time, 10:45 a.m. Eastern, New York time. Let's stay, I should say, with the banking sector. Bank of America has, we understand, started telling executives to pause hiring, except for those in the most vital of positions. This as it tries to keep a lid on costs. It's preparing for a possible economic downturn, of course. Joining us now for more on this Bloomberg story, Sally Bakewell. Sally, in some ways, a hiring freeze feels like good news relative to the cuts we're seeing at other institutions.
Yeah, that's perhaps right. A huge thing we saw coming out of bank earnings, which we had this week and toward the end of last week, was expenses. And banks were really punished for not getting a handle on expenses. You saw with Goldman Sachs, its shares were down because it posted operating expenses that were some 11% higher. And that trend was seen across Wall Street for those that also guided to higher expenses or posted higher expenses. And as a result, a really big lever to pull when you have higher expenses is job cuts. And we've seen Morgan Stanley start to do some job cuts. We saw Goldman Sachs come back with a big round of job cuts. Bank of America hasn't yet gone that far, but it is freezing, temporarily hiring until the economy starts to show signs of improving.
Well, what's interesting, though, is that the stock is down 2.4%. And I appreciate we can't make too much of a day-to-day reaction, but you would think if it's a sign of strength that the market would like it. What's your interpretation, or when you talk to analysts, about what the stock reaction is to the news?
Yeah, I think that it's a sign that perhaps job cuts, compensation cutting, we've seen a lot of bonuses also take a hit. Those perhaps aren't necessarily going to be enough for banks to avoid seeing their profits sapped by expense cost rises this year. They're having to contend with wage inflation, but they also have this tension with the kind of war for talent that hasn't actually gone away, as we perhaps see with the Credit Suisse news, where they're offering upfront cash bonuses to some of their staff. They do have to make sure, especially perhaps going into a recession, that they can keep talent.
And we understand that cash bonus will be repayable if the staff depart within 3 years. Feels like a mixed message, though, doesn't it, Sally, from Credit Suisse? We heard earlier on in the week from the chair, from Axel Lehmann, talking about the fact that it's been a horrifying year, that bonuses are going to be cut, yet they're trying to use incentives to keep the most senior, the most important people at the bank.
I think it speaks to exactly that trend, that going into a downturn, they really do need to retain some of their best talent. And so, indeed, Credit Suisse has had perhaps a more tumultuous time than most banks, and actually this may be a more crucial time. And it's also seen a huge drain on a lot of its key staff and a lot of its key talent. So this may be more of a time than ever when it needs to retain talent who can help it navigate in even a choppy period, like all the banks.
Right, sort of finding the happy medium. All right, Sally, thanks a lot. We appreciate it. Bloomberg, Sally Bakewell joining us on that news. You're looking at the S&P off by 0.8%. This is Bloomberg.